thanks very much for joining us. For those who don't know, maybe just tell us a little bit about the company and also the strategy.
Hilltop Credit Partners is a investment credit manager in the private debt sector. We were started about 3 years ago, and we are a collection of real estate asset managers, finance guys that have come together to create a firm, a product that addresses what we saw and what we see as a big dislocation between the supply of capital and the demand for capital in the residential development marketplace. We came in right at the sort of the tail end of Brexit. We're hit with, 3 bouts of COVID and other things that have been exciting and taking the news. And, remarkably, we've done super well. We've raised a lot of capital from various partners, institutional partners. I think we're close to about 600 million that we've raised in the last 2 years. And we have great relationships with some of the banks that we leverage our product with. And we've probably committed about half of that to date. To be more specific, we have a product, a whole loan, direct loan product that we provide to smaller, or I would say mid-size SME developers. And, I kind of use that term rather loosely because that could mean a lot of things, but typically our deal size is around 25 up to 100 million in terms of size that we lend. That particular product goes high in the leverage in the capital stack. So, if you looked at the entire capital stack, you'd have equity, senior, mezz, and maybe some pref. We do all of that all the way up to 90% of cost, which kind of caps out at around 75% of LTGDV in normal cases. Because we're equity guys, because we've all historically been on the other side of the transaction, and most of us have been born before 1982, which, means a lot because we've seen a lot of credit cycles come and go and different real estate cycles come and go. We understand the cyclical risk and the relative risk related to real estate. So, we take a view very much based on the underlying asset and try to anticipate movements in the market in order to make good decisions for our investors.
I'm going to come to the trends in a minute, Paul, but I just wanted to pick up on the role of technology. There's a large focus on prop tech, but also fintech. How much is that going to be driving the market, and how much of an important role, I suppose, do you see technology playing going forward?
I think increasingly a bigger and bigger role. And a lot of people throw the word around tech quite frequently because it gives them a better valuation and it makes you sound more exciting. At the end of the day, though, when you kind of compare the peer group tech that's out there, it's still rather analog. Real estate in its purest sense is a very heavy-handed industry in terms of being quite analog. There's a lot of manpower, a lot of junior analysts that crunch through deals and, do a lot of that work and gather information. And, I sit in a big boardroom where there's 40, 50 people, but not many of them talk to each other. So what tech should be able to do is to amalgamate all that information and bring it together so that everyone's working on the same platform in real time. Allowing both internal and external contributors to work together as if you were sitting around a table. So when I think of tech, I think of a needs-based tool in order to do more with less. And, that's what we've tried to do here at Hilltop, is to create a product that doesn't really replace the human element, because I think real estate's about knowing and understanding markets. Data helps you make those decisions, but there's nothing like getting in the car and going to kick the tires, and looking around and, determining whether the demographic of your area actually fits the data that you're looking at. So I think it's a helpful tool, but it doesn't replace what we do and the decisions that we make. Maybe someday it will, but in a virtual world, but we're not there. But I think that if you're in our game, if you're in the real estate game, be it credit or equity, you need these tools in order to be at the forefront of what is coming, which is, more data-driven decisions.
And you mentioned the capital raising side, Paul. Do you think there's going to be more capital looking towards the debt side, partly also because of the dislocation in the market?
It was the question I asked myself a couple of years ago when I started this business is, I've always been on the equity side, and I like the credit side for me personally because it allows us to have an overview of the entire market and it gives us scale. Unlike historically where I was, developing one-off units or 3 at a time, 4 at a time. So from a business point of view, I like the management, the deployment end of it better. But equally, the way we've structured our credit and the way we look at debt today, the risk-adjusted returns on credit to me are far more attractive than being purely on the equity side. And, I don't say that to scare the equity off. It's just that I like having the knowledge that I do have the first security on the asset and I do have some downside protection. And I do have tools that I can use to remedy situations if in fact I ever need to. For example, when we look at a deal, we never want to own it. We never want to manage it. That's not our job, but we have the tools in-house and the capabilities to do that, unlike a lot of our peers that don't. And I think a lot of capital is looking for investment managers with those unique skill sets, especially in markets that are quite unvanilla-like and uncertain, that have those skill sets, but equally have that data and that ability to access that data and put it to good use in order to make those decisions in the first place.
And just turning to the trends, Paul, I mean, you mentioned that you set up and there's been Brexit, the pandemic, a number of challenges, and now, of course, the war in Ukraine. But what are you seeing as some of the key trends that are driving the markets and sectors that you're looking at?
I guess you have to take a view on certain things. And because of technology and because of the way the world works today, an event happens and you get an immediate reaction. Someone was saying the other day, it's sort of like being on the M25 is if there's an accident, everyone hits the brakes and everything stops. And then it takes 3 times as long for traffic to get moving again. But when it stops, it stops. And it's the same thing today. I mean, because we're inundated with instantaneous information from around the world, the reactions to things tend to be quite quick. So you saw a big spike in commodity prices. You saw a big spike there were already the supply disruptions happening, but then you had cost increases that exacerbated that problem. If you look at those increases now, if you look at the price of timber, you look at the price of copper, you look at a lot of the raw materials that are going into construction, those prices actually peaked out in May. And they're already coming down. So I think we'll see those filtering through to the system in the next 6 months. But the immediate reaction was quite profound. And everybody started talking about, massive cost inflations. And of course they were there, but it was more, in my opinion, a sentimental sort of reaction at the moment. Fortunately, in our book, we haven't experienced a lot. I'd be lying to say that we didn't have any of those issues, but I'd say on the whole, we were very fortunate that our sponsors were very forthcoming in terms of being able to plan ahead and buy equipment and material ahead of schedule. So if we're 10% above budget on particular deals, I think that's a really great result. And some of them have come even in under budget, surprisingly. So you've got cost inflation as one issue. Then you've got, what's happened politically with interest rates. Sentiment is changing in the market. There isn't this sense of urgency that I've got to go run out and buy a house tomorrow. They're all being taken. Well, they're not. And I think what you'll see is a slowdown in velocity. You're seeing it now. You'll see a slowdown in velocity in terms of sales transaction. And typically when you've got that sort of slowdown in velocity, one thing happens, and that is the spread between bid and ask just widens. Usually the ask is the last thing that moves lower. So you're going to have this period before the ask comes down where people just aren't encouraged to transact as quickly as they were in the last couple of years. And what that'll do is it'll slow down it'll have a knock-on effect. So completions are already down by 50% over the last 3 years. So we're not maintaining, we're not catching up to that structural shortfall that everybody talks about in the housing sector. But the pressure is going to be less because people aren't going to make those decisions now. So the next question is, well, what happens to all that stock that's being built? Was that stock appropriate for the time? Maybe there was a lot of stock that was being built that was not appropriate, but what happens to all that stock in the market? And I think that there needs to be some sort of transformation between the ideological idea of build to sell versus build to rent. Now, one of the problems that we've had here in the UK is the build to rent sector is very fragmented. It's always been mom and pop. It's been small. It's been small portfolios of deals. So larger institutions that have a great appetite for income, that have made huge inroads in the US market, for example, because that stock is there. It was built in the 1950s, 60s, and 70s, just needed some core plus paint and repositioning. But there were a lot of that particular asset class in the multifamily sector was huge. It doesn't exist here. And I think that there are a lot of clever guys in New York or wherever that thought, oh, well, we can take a build to rent product and amenitize it and create this great place with amenitized space and all, that people can live in. I think the problem with that model is it's expensive. It's expensive to manage. So you've got asset property management costs that need to be passed on to the buyer or to the renter. And typically the renter that's renting those units can't afford those costs. So it's more expensive to build, it's more expensive to manage. And at the end of the day, it's more expensive to let. And if you can afford those kind of service charges, you probably won't be living in a flat. You probably be living in the Cotswolds, as a huge generality, of course. But so I think the market needs to sort of find a way to take some of that built to sell stock and turn it into workforce housing for built to rent that isn't amenitized, because not everybody can afford that. Not everyone can afford to build it. And when you look at the leakage between the gross yields and the net yields that investors will get on that, the spread's pretty wide because of all these management costs that have to be built into that.
Yeah, I think it's really interesting, both that focus on debt and credit from the institutional investors, but also that potential change in the UK residential market. Really interesting to get your views. Thanks very much for joining us, Paul.
Thanks so much for having me.